Hey there, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. We have a great guest today, by the way, Dave Landry of DaveLandry.com. Talk about, when I intro the show, I always mention the benefits of technical analysis, and in my head, I always think, is there one little nugget of wisdom I could just quickly share as to why we look at charts? I'm going to save that for my conversation with Dave because I have a sense he will probably share some really thoughtful ideas about why technical analysis should work in the first place. But let's reflect on our time together on this show every day as a way of understanding the markets through the lenses of charts. Charts tell us about what individual investors and in aggregate, all that group, the cohort of investors and traders, what they're thinking, what they're feeling, and how those thoughts and feelings are expressed in the form of price action. With that in mind, let's get to our market recap and look at how things actually played out today. As we're bringing up the charts, I do want to share with you a very interesting poll because we asked you in the last 24 hours, will Feb 2024 be a positive month or a negative month for the S&P 500? About 2 out of 3 of you, just a little under that, said a negative month, and I would have to agree. And you know, interesting, I'd love a follow-up question underneath the poll. What makes you think that? But I mean, things that we've talked about on the show certainly are why I would answer negative. I mean, number one, just the fact that January was so strong. Q1 of an election year actually tends to be choppy, if not net weak, and certainly going into March when there tends to be a low. So if we're pretty strong in January and if we're expecting a low in March, February is sort of that middle point where we have to get from point A to point B. So I think that's a logical expectation given the run that we've had. But I think one of the reasons why I think that makes sense now is just the fact that the breadth conditions, which were so strong in mid-late December, have now become a lot less strong. And as much as it feels like a lot of names are holding up, which again, many of them are, but a lot of names are not. And we see that in the fact that, you know, under 70% of S&P members are above their 50-day moving average. That's down from about 90%. So we're seeing some stocks break down. It's not everything, and a lot of the big names are still doing just fine. But let's reflect on the fact that the breadth conditions starting to roll over. Let's go with the market recap and look at the averages today. The S&P 500 up about 0.25%, 49.54. We are still below that 5,000 level, and as a gentle reminder, I did mention if and when the S&P closes above 5,000, I'd play a trumpet on the air, which we'll figure out a way to do so. But we're very, very close, and since we got to a very close level, we still haven't broken out. So the horn is still in its case, as it were. We'll see if February ends up being weaker. Maybe my playing will be delayed a little bit further. The NASDAQ composite actually just narrowly finished in the green. It was actually in the red for most of the trading day, but the NASDAQ composite finishing around 15,609. Again, that's just slightly above yesterday's close. Mid caps and small caps both up, and that's outperforming the S&P's positive 0.25%. The NASDAQ 100, and this is interesting, one of the few places you'll see red on these initial screens is the NASDAQ 100. So the largest growthy names in the NASDAQ actually down about 0.25%, and the VIX in the red as well. And I do want to address, because we got this question in the mailbag. Next mailbag show, we'll probably talk about it in a little more detail. But today we have a similar thing that I think we saw yesterday or the day before, which was the S&P finishing higher and the VIX going slightly lower. There have been times when the S&P and the VIX actually moved together. And that's, I think, what we saw yesterday. Slightly lower S&P and slightly lower VIX. Which you have to remember, they're not directly tied to one another, right? So the VIX is a measure of volatility. The S&P is a measure of price action. And so stocks often move down on higher volatility, usually, and they usually move up on lower volatility. That's just the way that markets tend to trade. But that doesn't mean that we can't have the opposite. We can have stocks going higher on higher volatility. It's just not as common. We can have stocks going down on lower volatility. Because the VIX is actually looking at index options for the S&P 500 contracts, right? So it's looking at options on the index and looking at the volatility there and kind of implying a volatility for the broader equity space. So it is theoretically possible, although not as common, to have them moving together. What happened today is more usual, more common, where stocks are higher, VIX is lower, stocks are lower, VIX is higher. So today a little more of a normal day. And the VIX again at 13, pretty low compared to long-term averages. There have been periods probably like the one we're in now, where the volatility actually remains in the low teens, if not even lower, down to single digits, and can remain in that range for quite some time. That's usually the mark of a sustained uptrend, right? Kind of a slow and steady grind higher. What you look for in this environment is a spike in the VIX, not happening today. Overall volatility remaining quite low. Quite a bit of movement in the fixed income market, so we'll spend a little bit of time looking at this, at a couple of these charts today. 10-year, 5-year, 30-year points all coming down. So this is the sort of mid to long part of the yield curve. The short end of the yield curve is here, and that's really more tied to what the Fed is actually doing, right? So we talk about the Fed last week not making any change. They really control the very shortest end of the yield curve, which is where banks are borrowing from each other, lending money, borrowing money from the government. That's all at the short end. It's called the discount window and other things I don't want to really talk about on the final bar, but that is what the Fed is actually doing. All the other parts of the yield curve certainly have far-reaching implications for consumers, for companies, how they are raising capital, whether they are lending money, banks and their business models, individual consumers, and when you go to buy, make a big purchase or take out a loan to start a small business, the yield curve really impacts that to a great deal. So yields tending to remain higher would pretty much suggest that it's not a great environment. That's a decision by the Fed keeping rates higher to intentionally slow down the economy and to bring inflation into check. So one of the reasons, if not the reason, why the Fed has kept short-term rates relatively high and not started to cut rates is because the economy certainly hasn't slowed down to their benchmarks just yet. Inflation is still above that 2% bogey for the CPI that they mentioned. And so, potentially overall, the economy still needs some slowing. It will be interesting to see how these continue to play out. But for today, interest rates coming down, the 10-year yield down below 4.1%, and bond prices popping higher. We've highlighted the AG and the TLT occasionally. Maybe we'll look at the TLT time permitting. The dollar index down slightly from yesterday's close, about 0.3% lower. Commodities overall doing fine today. You have the GLD up 0.5%, silver up just under 0.25%, copper prices, even crude oil prices moving higher. So besides natural gas and some of the soft commodities like corn, overall commodities slightly higher today. Cryptocurrencies in the green as well. Bitcoin higher by about just over 1%. Ether prices about 3.5% higher. We're at 23.80 there. And the rest of the major coins, for the most part, stronger rather than weaker. Looking at the 11 S&P sectors, you can see materials, real estate, healthcare are your top 3 sectors today. All 3 of those up over 1%. Materials, number 1, up 1.8%. Materials is one of those sectors that I think a lot of people have just not cared too much about. When I think of those forgotten sectors, the 2 that come to mind are healthcare and materials. Those are names that I feel like we've been talking about growthy stuff like technology and communication services, or defensive sectors like utilities, or even something like an energy, which at times has been one of the top gaining sectors. Materials and healthcare are relatively small percentage, particularly materials I'm speaking of there, and pushing higher. So maybe an interesting place to look on when days like today continue to continue. You continue to see more strength in materials. Seeing them at the top of the list is what makes me want to dig in a little bit, maybe use the scanning engine to find some of the names that are leading higher. Well, let's go to the Keller market model, which is one of the new objects or the new widgets on our stock charts dashboard. Hopefully one of many cool things we'll be doing to enhance the dashboard. I do want to highlight yesterday's close. 2 of these actually flipped. So as we were going live with the show yesterday, I was highlighting that all 4 of the major equity averages, large cap, mid cap, small cap, NASDAQ 100, were all bullish across the board. As of yesterday's close, the small cap and mid-cap short-term models going slightly negative. Now, I formally don't change the model until Friday at the close, but we chose to kind of show real time if there are any changes, because as a monitoring tool, I think that's helpful to see that the short-term picture is starting to change. So as we remain, see, just as we were doing this, the mid-cap model just popped slightly back to positive on the short term. I'd be watching this going between now and the end of the week. Friday's close again is when I'll lock in the new values for it, but small caps and big caps is where you tend to see weakness first. So the fact that large caps, the S&P 500 has been making new highs December into January, mid caps have not, small caps certainly have not, making lower highs. Watch to see if that short-term model turns negative. Again, we're kind of right at that point where they're going very, very quickly between bullish and bearish. Let's check in on a chart of the S&P 500 here, and the daily chart of the S&P 500 again showing strength. And I think on yesterday's show we talked about a trend line analysis. The first trend line that I'd drawn off of the lows in October is this blue one, and really lined the October low with this secondary low in early December. You can see we tested that level here in mid-December and then finally broke down through it right between Christmas and New Year's. And, they really didn't suggest that we're necessarily going to retest the lows, but more that just the uptrend is no longer in phase. And that's kind of what we've seen now, right? There's a sort of 6 or 7 week period here where we have a sideways congestion range, the S&P between 4,700 and 4,800, and that finally resolved higher a couple of weeks ago in mid-January as we broke out of that range to the upside. So what I've now done is taken the original low in October, connected this new low from mid-January, and you can see that lines up really well with the low that we had about a week ago in late January, and you can see that's our new trend line. So the way that I would use this sort of tool is basically have this on a chart that I look at every day, and every day I'm just looking, are we still above that green trend line? And if so, things just aren't that bad, regardless of what happens on an individual day, regardless of what I see the FANG stocks doing or any particular sector or any breadth indicators. As long as the S&P remains above this ascending trend line, things are pretty good, because what that means is by definition we're making higher highs and higher lows. And that's Charles Dow 101, market in an uptrend. So look to see if that trend would continue. For now, it tells us we're fine, right? We're in good shape here. Now, what's interesting is as we go through some of the indicators that can help us qualify those trends, right? So the trend in the S&P 500 is one thing. What about all the companies that comprise those indexes? Here we're showing the McClellan Oscillator. It's kind of busy here recently because we've been chopping around this zero level. And what the McClellan Oscillator basically does, yesterday on the show we talked about that dispersion between large caps and small caps. So I guess divergence is a better way to describe that, right? Large caps going higher, small caps going lower. The breadth data, right? The advanced decline line on the S&P has been trending up, while the advanced decline line on small caps has actually been trending lower. This McClellan Oscillator looks at the New York Stock Exchange listings and basically looks at the change in the advanced decline data over time, uses some moving averages to calculate an oscillator called the McClellan Oscillator. Very simply, if the McClellan Oscillator is above zero, this is a tactical bullish phase because the breadth data is improving. If the McClellan Oscillator is below zero, that's a bearish short-term phase because the trend is going lower. And it really is more of a short-term indicator, right? You can see I've highlighted when the McClellan Oscillator is above zero in green, below zero in red. You can see that it's at most a couple weeks, if not maybe a couple months at most, if there's more of a longer-term uptrend like we saw in November and December. But often you'll get these quick little moves one way or the other because it's really looking at how the short-term breadth conditions are changing. Yesterday, we finally got below the zero line and stayed there on yesterday's close. We'll have to see if today it's able to push back above the zero line. But as of yesterday's close, for me, that puts it back in the bearish camp. I don't change it if we go through the level one day and then reverse back. I wait to see if there's a confirmation day, a second day. And so now I've color coded this back to bearish red, which means, again, tactical time frame, short-term time frame. It suggests that this rally that we've experienced up until this week may be starting to stall out a little bit. And that's, goes along with some of the other charts that we've talked about. For example, the percent of stocks above their 50-day from 90% down to 60%. Today bouncing up a little bit, but still around, at best 2 out of 3 stocks. And that's down from 90% back here at the beginning of the year. So just in the first 4 to 5 weeks of 2024, we've seen a lot of members of the S&P 500, which are still pretty decent-sized stocks, breaking below their 50-day moving average. They were above, and now they're below. And so that's not a great sign as the S&P is trending higher. Just look at the divergence between price and breadth. And so again, that's why I'm skeptical of February being a particularly strong month, given the rally in January and given the weakening breadth conditions here most recently. Let's go to interest rates here very briefly as we finish up our market recap. Then if we have time, we'll go to a stock or two to round out the recap. But I'm looking at bond prices. Overall, I would say bond prices are in an uptrend if you're looking at the momentum characteristics. This is the TLT, and we've highlighted the ag recently on the show as well. I've color-coded the RSI indicator green or red depending on which phase it's in, right? So when the RSI tends to become oversold on sell-offs and doesn't really get much above 60 on rallies, that's sort of the bearish phase. In a bullish trend, you see the entire range of the RSI move up. We tend to become overbought on rallies, and the RSI doesn't get below 40 on pullback. So most recently, I would say in November, we've changed from a bearish phase for bond prices to more of a bullish phase. Now, it's sort of an interesting point here because this most recent rally really didn't get to the overbought level. So maybe we're in a bit of a change here. But as long as the RSI holds 40 on pullbacks, I think this is still pretty good. So from a technical perspective, I think we're right at the 200-day moving average here today. We're just above the swing low from January, which is around 93 on the TLT. I think as long as we hold that, I would still think of this as an uptrend overall, but you really need to see this to get back above 100 to complete or continue that bullish phase that we saw in the fourth quarter of last year. So if you think about it, if bonds are still in an uptrend according to price, and if they still keep making higher highs and higher lows, then rates are coming down, right? And interest rates are coming down, which means things are getting a little more affordable. And unfortunately, that doesn't really jive with what the Fed is trying to do by keeping rates elevated and essentially trying to slow down economic conditions. So will be interesting what would happen if rates just sort of go down on their own and if bond prices rally, and what that does for the Fed's line of thinking as they continue to observe some of this economic data. Just to finish off, let's look at a couple names as we can. Adobe is a name that comes to mind because it's pulled back to the 50-day moving average. We talk about sort of that fat pitch chart, which is a long-term uptrend, short-term weakness. And as you can see from Adobe, we've stalled out at the previous resistance level. Here's the high from November and December around 630 to 640. You can see we retested that level here in the last week. Looks like it might actually be breaking out, but it's now pulled back and once again testing the 50-day moving average. We've had a couple breakdowns of the 50-day here at the end of last year, beginning of this year. So look to see if it can finally hold that. But on this sort of pattern, again, just think of the Dow Theory 101, right? An uptrend is when we keep making new highs. We've now stopped doing that. So a downtrend would be lower highs and lower lows, which means Adobe below 560 would be sort of a cautionary, this is really starting to get worse. So as a Stock Charts member, this is where I would probably put an alert, 560. Just make sure if you're not looking at Adobe every day, you get an alert when that sort of level is broken. That's sort of what you want to be paying attention to. Align, ALGN, is a medical supply company. I just want to highlight, this is one actually approaching its 200-day moving average from below. Now, what's interesting here is you think about the chart of Adobe where we've rallied up to resistance and now we've stalled out. Align kind of did that same thing here in December and January, and just a couple days ago actually rallied or opened above the 200-day moving average, but closed right back where it started or had ended the previous day. Today, we're actually pushing back up. Nice rally, almost 5% higher, right back to that 200-day moving average. We've quoted Paul Tudor Jones a number of times. Nothing good happens below the 200-day moving average. So this stock getting above the 200-day, holding that, having a follow-through above there, that's where a chart like this becomes a lot more constructive. So another one to keep an eye on to see if it's able to get above the 200-day and stay there. In terms of earnings names, we had a couple names reporting before the open today, actually quite a few, but a couple that I'll highlight. Eli Lilly, same sector, different group, pharmaceuticals. We can see that that unfortunate earnings moment where we open higher but trade lower, right? So when a stock gaps higher at the open, encouraging, right? A stock opens way up and you're thinking, all right, this is great, Eli Lilly. But here's the thing. What happened was people were selling that gap higher. You can see that by the fact that price has gone down. And we actually ended up not much change from yesterday's close. So we gapped open how much higher on earnings, but by the close, we had basically given all of those gains up. So what that tells me is people were thrilled to cash out at Eli Lilly up around here. That brings the price right back to yesterday's close around 705. That's not a great sign for the stock. Spotify's another one. Now, it didn't get all the way back to yesterday's close, but we opened around 240, did trade up to 250, but got down to around 231. Now, a lot of the charting work that we talk about on the final bar is really more medium-term to long-term, but don't think that you can't or shouldn't pay attention to the short-term dynamics. We often focus on a short-term candle chart, and that's where I find candlesticks are super helpful, looking for engulfing patterns and doji candles, which represent indecision, or any of those other patterns like hammer candles that suggest a reversal. Those are all based on short-term price dynamics. So when a company reports earnings, it's a really good time to bring up those shorter term charts, looking at like 3 to 6 months. Just see what happened. Did we gap higher or lower? What happened after that open? Do you see additional buyers coming in? Do you see selling pressure coming into the market? And that can tell you a little bit about what the short-term sentiment is, what that means for the longer-term trend. A chart like Spotify, still okay, right? Still making higher highs and higher lows, but today's sell-off going into the close doesn't make me particularly optimistic about further upside without a bit more of a potential retracement. That's it for today's market recap. A lot to unpack. Hopefully we touched on some of the names and some of the charts that we think are most helpful for you. One quick announcement before we bring on today's guest, Dave Landry, and that's this. We love hearing from you. Our mailbag can always use another question. I can't thank you guys enough for sending in some really thoughtful questions. As always, include a permalink or a little hyperlink to the chart that you're looking at. That helps us to see what you're looking at with your question. Email is the best way to get your questions in front of us, thefinalbar@stockcharts.com. You can tag us on X @FinalBarSCTV, and on YouTube, of course, just drop a comment below the video that you're watching. We'll hope to answer one of your questions in our next mailbag episode. I want to welcome on today's guest, Dave Landry. Dave's the founder of DaveLandry.com. He's been a frequent guest on Stock Charts TV and on our show, The Final Bar. Always brings some trading wisdom along with him. Dave, good to see you. Happy New Year. Welcome back.
Great to be back. Happy New Year too, Dave.
So, we were talking about what to do today. You offered up 3 things you wish someone would have told you as you were just getting started trading. I'm super excited to hear what sort of things you have in store for us. Get us started. What sort of things would you wish you would have heard early on?
Well, and this one's going to sound kind of silly, but markets go up and markets go down, and you tell somebody that they say duh, or look at you like you pooed your pants or something. But the bottom line is they do, and you have to be ready for that, and you have to be willing to sometimes take a loss, often take a loss in the markets. And the other thing you have to do is you have to make sure you're in the best setups to begin with, make sure you're trading in the best conditions to begin with. And sometimes that means a heck of a lot of waiting, and a lot of people really aren't accustomed to waiting around. And then there's actually a whole psychology behind why you take mediocre setups, is because in life you're trading to take whatever train wreck comes along, so to speak. And that's coming from a client of mine who's a psychiatrist who explained that to me. But a lot of waiting, and you have to be willing to accept the fact that the market will go down.
So what sort of timing system do you use to figure out whether it's the time to take action or not?
Well, for the overall market, as a general statement, I like the TFM 10% system. And one of my clients, actually a trader I respect, pointed out that it's, and I respect my clients too, but he pointed out that that's as good as anything out there. And that was very flattering for me. And I've done a lot of back testing on a lot of systems over the years. And it's a pretty simple system. Basically, the thinking is, and it's just kind of technical analysis 101, if a market's going to drop 50% or more, it's going to drop 10% first. So when it drops 10% and closes below the 50-week moving average, 10% from its 50-week closing high, you want to look to get out of the market.
Right. So as long as the S&P or whatever index is holding within 10% of that all-time high, we're still okay, which gives us some room to pull back, I guess, and still with being an okay structure, right?
Yeah, and that's where you kind of want to be a little hands-off and let it unfold and not get too caught up in the zigs and zags, which is hard, especially if you're sitting in front of, I don't even know how many, 6 or 7 monitors all day, and each little zig and zag becomes much bigger than it really is.
Yeah. When you're looking at the cockpit of screens that you have and looking for individual ideas, what sort of tool do you use to find entry and exits at an individual level?
I'm looking for something that's in a really solid trend, ideally a persistent trend, an accelerated trend, or an emerging trend, meaning that it's bottomed out and now it's beginning to rally, or for shorts, just the opposite on the downside. And then I'd say everything that I do, with the exception of one IPO breakout pattern, is pullback based. So I'm looking for a pullback, and I'm not buying the dip, so to speak. I'm waiting for that market to rally up, and I'm looking to enter on an entry, of course. And that one little thing in and of itself, just to slip it a little tip, will keep you out of a lot of trouble. I'm often amazed how many bad setups, losing trades you can avoid just by waiting for an entry, waiting for that confirmation for the market to go right back up.
Oh, that's great. And I should have mentioned, I know with your the 10% system we mentioned earlier, you have a free ACP plugin that includes that, some other indicators too, which I'd encourage people to check out. So it's a great set of tools that you provided. All right, so number one, markets go up, markets go down. Very, very fair. What's number two?
Well, number two is you can't time off of fundamentals, and fundamentals make a lot of sense if you think about it, it's like you want to buy good companies with good earnings and the books look good and all these other great things. Unfortunately, you can't really time off of them. Fundamentals don't really have anything to do with timing. It's more what a market should be doing, but not what a market is actually doing. And that line of reasoning comes from Greg Morris. And my biggest argument, and I think I mentioned this to you, I'm working on a book, and one of my chapters is going to be apologetics, where I defend technical analysis, but more specifically, simplified performance-based technical analysis, buying things that go up, selling things that go down type of technical analysis. And my biggest argument against the fundamentals is the institutions, as you probably know, you spent a lot of time over at Fidelity, they have just tremendous amount of resources, hundreds, if not thousands on staff, millions of computers, and then they have unprecedented access to CFOs, CEOs, et cetera. And 90 to 98%, depending on what subsector you're looking at, cannot beat the S&P 500. So if they can't do it with fundamentals, I don't think a personal trader, a private trader like us, can do it. So that's where the technicals come along. Technicals are all about the timing, and then fundamentals are what should happen, and timing, obviously, or technical analysis is what's actually happening in the market.
Do you think fundamental analysis still has a place for individual investors, and how would you think of it as part of a process?
No, if anything, I think that you could probably look for bad fundamentals and momentum, and that way you know that stock is trading purely on emotion. That's why I like IPOs are so amazing. But I've yet to find a use for fundamentals. And the problem with fundamentals is, let's say everything looks fantastic at 10, and then the stock drops to 5 after you buy it. Well, everything should be even more fantastic at 5. And eventually, I'll concede this. Eventually, the market will reflect the fundamentals, but eventually it could be a long, long time. And in the meantime, competition could arise, wars could erupt, and God knows what else could happen in the markets, as you know.
Yeah. It's funny, efficient markets hypothesis, not to get too much into the weeds, sort of assumes that stocks immediately traded their fundamentals. I think the place where you and I live looking at the charts recognizes that that's not instantaneous. There's that gap between where something should be and where it actually is. I think Greg Morris's quote is spot on for that. All right, so the second one, you can't time off the fundamentals. No disagreement there for me. What's the third one?
The third one is all you need is one pattern to be successful. And that's what Linda Raschke once said. And I firmly believe her. If you're not successful with one simple pattern, you're not going to be successful with a dozen. So I would find something really simple and stick with that, and not just look at something on a mechanical basis and find something sort of mechanical, which I'll show you here in a few seconds, but then make sure you learn how to pick the best of those and get a little experience with that one pattern. Trade at a super small size until you become successful, and then slowly add on, and then over time maybe add a few other patterns to what you're doing.
We have an example here that you shared with us. Share with us what this one pattern is for you and how you're looking at it here.
Okay, as I think I mentioned earlier, most of what I do is based on pullbacks.
Sure.
One of my favorite patterns with IPOs would be a first pullback at an IPO, and a hot IPO, and that's all the way obviously to the left on this K and F. And we didn't have a moving average initially, but then the moving average came in. So with the Landry Light pullback, you're looking for 10 to ideally 20 bars of lows greater than the moving average. And you're looking for a pullback to that moving average. And then you're looking to get in, as I said a second ago, on an entry, provided, of course, an entry meaning that the stock begins to rally. If you look all the way to the right, the last time we had lots of Landry Light, we had about 40 bars or so. And then notice we pull back to the moving average, which gives you 0. And then that would be another pullback, a Landry Light pullback there. So basically you can quantify this, but I'm not saying to rush out and trade it on a mechanical basis. What I would do is I would look for those things I mentioned earlier, such as persistency, such as acceleration. And then I have a bunch of other little trend qualifiers, such as wide range bars in the direction of the trend, strong closes, etc. And then you want to see a somewhat orderly pullback to that 30 EMA. And then again, look to enter if and only if it triggers an entry.
And you have the 30-bar EMA that you're showing on this particular example with the Landry Light. Is that sort of the standard setting that you use, or are you changing that based on the name or anything like that?
Well, it is for stocks. And the reason I used to use a 20 EMA, and I actually published the same exact pattern. And I think it was the Layman's Guide to Trading Stocks. And I used a 20 EMA then, and for many years that was sort of my favorite moving average. I know you go to party with me, but in more recent times, I've started using the 30 EMA more and more, and I find that it really helps to keep you on the right side of the market.
I love it. So 3 fantastic things you wish you would have heard. Markets go up and markets can go down. You can't time off the fundamentals. Let's use the charts as a timing tool. All you need is one simple setup. You highlighted the Landry light. Anything else you'd share with us in terms of words of wisdom?
I would say you really need to get to know yourself, and the psychology is huge. And as you know, I've spent a lot of time working on that. And there's actually a neurology involved too. And there's also a lot of emotions, and you can't control your emotions, and that's neurology. So the way you deal with that is you document. You document not only just your trades, but document what you're thinking, how you're feeling, etc. And just little things. Just a real quick anecdote here. I used to walk into my office, and I called it the walk in the office trade, and I'd put it on a trade, immediately lose money. Couldn't figure out what I was doing, and then one day I read about the so I stopped doing that, obviously, but then I read about the hangry judge effect, where the judges, and I know I've mentioned this before, but the judges would give these very stringent sentences before lunch, but then after lunch they were a lot more lenient. So if you're going to be sentenced, you want to be sentenced after lunch. Obviously, that was a study done, and I think by a guy named Irely, and that was in Israel. They did that study. So I just found that kind of fascinating. What it was, I was hungry in a bad mood. And then when I came back from lunch, everything just looked beautiful. And then I found myself making unnecessary trades. So it's kind of getting to know yourself. And then another great way, and I know you do this, and you're a big fan of this, is first thing I do every morning when I wake up is I write 3 handwritten pages. And it's just free form, and I don't worry about what I'm writing. I'm not trying to write War and Peace or be eloquent or anything, just anything. It's like, boy, I really, did really bad yesterday. Why did I do bad? You find yourself you find yourself asking questions, and then you find yourself answering them, and you'll learn a lot about yourself in the process. And just stupid little things like you'll write down what you're worried about, and then 6 weeks from now, you're like, why was I even worried about that? 90% of it doesn't come true. And if it does come true, you have to deal with it anyway. So it's a great exercise. And I know you're a big fan of doing that too. I think Julia Cameron was the person that talked about doing that. I did it many years ago before I heard about her, but in more recent years, I started again after reading her book.
Yeah, The Artist's Way. She talks about that as a way to unleash creativity, and we are kindred spirits. I did that this morning. I found it to be an incredibly therapeutic exercise every day.
And here's the amazing thing, Dave. It's free, okay? Pen and paper, whatever, which you probably already have. But I tell everyone I meet to do this. A lot of people that don't even want to hear from me, and I haven't found one person that actually does them yet. So, but it's a very powerful thing. Hardest thing you've ever done for the first 6 weeks, as you probably know. But I actually wake up now and look forward to writing, just to get all this crap out of my head so I can start my day. So.
I love that. I love the bonus tip today, Dave. Listen, this was awesome. And each one of those 3 main tips that you share with us, there's a lot of wisdom behind those. And I appreciate you showing an example or two and helping us understand some of these things we should keep in mind going forward. Good to talk with you, Dave. Good to see you. Happy New Year. We'll do this again, all right?
We will. Thank you so much.
That's Dave Landry. Dave's the founder of DaveLandry.com. And again, Dave and I really have enjoyed over the years talking about just the mental state, the mental challenges, the mental hurdles of trading. And I love these conversations with Dave, just things that he's laid out. If you even just take these little points and think about how you can apply them, just one little tweak to your process today, this week, this month, talk about some improvements you could experience over time. Great words of wisdom there from an experienced trader, Dave Landry of DaveLandry.com. And now, folks, let's go right to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. So we're looking at the McClellan Oscillator here. In our market recap, we talked about breadth conditions. And again, long-term breadth conditions still constructive. Short-term breadth conditions, I would argue, getting pretty weak very, very quickly. And so January was a bullish month for the market as a whole, the equity markets. But in terms of breadth conditions, I'm seeing a lot of non-confirmation, right? I'm seeing the S&P go higher on weaker breadth. The McClellan Oscillator turned negative for me yesterday at the close. It had gone below the 0 level 2 days ago, but then yesterday sort of completed that move lower. And so for me, that just tells me to be a little more thinking down rather than up as a tactical call because the breadth data has basically rotated a little bit lower. I think the other implications of this sort of chart rotating down into a bearish phase is what it tells you about the breadth conditions and how they're evolving, right? Stocks in general moving higher along with the market means breadth conditions should be improving. That's what breadth is meant to measure, participation. When the McClellan Oscillator is going negative while the S&P is making new highs, that tells me that the market's going up, but not all the stocks that I probably care about are participating in that up move. Participation is not improving. It's actually getting a little bit worse here. Chart number 2 is home builders. We've highlighted this chart here. I just want to focus when we think about interest rates, when we think about the Fed, when we think about whether February is a positive or negative month for stocks. A lot of that has to do with economic conditions and sort of the optimism or pessimism that investors are pricing into the markets at any given time. Home builders were a really good chart in November and December as we just pushed higher, and charts like Lennar and Toll Brothers and others having these nice upswings. But if you look at the last 6 weeks, the ITB, which is one of the 2 home builders ETFs that I like to follow, very much sideways, right? And so there are a lot of charts that are not going down. Home builders are not going down. It's still not a bad chart, but it's not a great chart, right? Great charts are like Nvidia or Meta making new highs, right? And keeping that pattern of higher highs and higher lows. The last 6 weeks for the home builder group has been sideways at best. And so we're in a range between around 97 and we'll call it 103. What's interesting is the lower end of this range is right at the 50-day moving average. So as I'm looking at this chart in the month of February, what would be the trigger that would tell me, things are starting to get a little tactical weak. Maybe I want to lighten up on positions and just look for a better entry point a little bit lower. Something like ITB breaking the 50-day, breaking out of this range to the downside would be a warning sign. Now, to be clear, we're not seeing that yet, but I'm seeing a stalled out uptrend. I'm seeing weakening momentum. That tells me to just be ready, put this on a list, and be looking for a breakdown. Great place to set an alert. ITB around 97, and a break below that would get you below the 50-day moving average. Could suggest short-term weakness and a little less optimism that have been priced into home builders to date. Finally, here's your friendly PSA. I like to randomly put stocks like this on the 3 of 3, just names that are breaking down. The reason why I want to highlight Charter Communications CHTR is the fact that we gapped lower a couple days ago. This is on Friday's session, and then Monday, Tuesday, just continuing. So when stocks go down, this is that dreaded falling knife sort of thing. When a stock gaps lower like this and it's at a support level, I know a lot of people think, oh, wow, great. I didn't want to own it here at 370, 380, but now down at 320. That's a much better deal. The proverbial falling knife really is a problem, and there's a reason why we don't tend to want to catch falling knives, because they can go much lower. I was taught prices go down for a reason. I thought today's guest, Dave Landry, really addressed that general concept very well. If you look to the left on this chart, you're thinking, wow, key price support, maybe it holds at 320, but it isn't happening, right? So when stocks go lower, I find, particularly when it's below a 200-day moving average that is sloping down, particularly when it's making lower highs and lower lows, it's best to be patient, wait for the right opportunity. And a stock making new 52-week lows, for me, is usually not the right opportunity. I'd much rather be looking at the stocks making new 3-month highs and look for opportunities that are maybe earlier on in a breakout out of a basing pattern. For something like CHTR, I think you still have to sit on your hands a bit and wait for the right opportunity. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the Final Bar. Special thank you to Dave Landry of DaveLandry.com joining us from New Orleans. Thanks for liking this video. And if you like what we're doing here on the Final Bar, feel free to subscribe so you don't miss our next episode. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night. Yeah, hey Elon, how you doing? Yeah, no, things are good. Just did the show. Yeah, no, your cars are good. They just all look very similar. Have you noticed that? I mean, maybe shake it up a little bit. Different colors. Yeah. All right, talk to you soon. No, you hang up.